Welcome to Big Picture Earnings Analysis.
Today, we are jumping straight into C3.AI's fiscal second quarter 2026 results.
Exactly. We're going to dissect the numbers, the explosive growth in their federal business, and really what the guidance tells us about the road ahead.
It was certainly a solid quarter, ending October 31st. They managed to top expectations, which is always the first hurdle.
So what did that top-line revenue look like?
It came in at $75.1 million. Now, that only just nudged past the consensus estimate of $74.93 million, but, a beat is a beat.
Right, but the bottom line, that was a much cleaner surprise, wasn't it?
It was. The non-GAAP net loss per share was 25 cents. That was a healthy 8 cents better than the street was expecting.
So financially, they outperformed, but I think the real story here is less about the margin of that beat and more about where that revenue is coming from.
Absolutely. The structure is crucial. Subscription revenue was $70.2 million.
Which is, what, over 90% of the total?
23%. It shows a huge focus on that stable recurring income.
And if you add in their prioritized engineering services, you get to.
You're 99% of total revenue. It's an incredibly predictable base. Just what Wall Street looks for in these kinds of models.
So that predictability lets them invest. But what about the actual, the full GAAP loss?
Well, the GAAP net loss per share was 75 cents. That gives you the truer picture of their spending.
But their operational efficiency seems decent.
It is. Non-GAAP gross margin stood at 54%, which translates to about $40.9 million in gross profit.
54% is pretty solid for a company in a heavy growth phase. Let's talk liquidity, though. That GAAP loss suggests a high cash burn. How's the balance sheet?
They are sitting on a fortress.
Really?
Oh, yeah. Cash equivalents and marketable securities total $675 million. It's a critical buffer.
Yeah.
It gives them years of runway to push these new AI products without needing to raise more capital.
Okay, so let's unpack where that investment is going. The CEO pointed right to their federal business. This is where things get really interesting.
This is the explosive part of the story. We saw near triple-digit growth. Federal bookings across defense and aerospace. They grew an astonishing 89% year over year.
89%. And that made up what portion of the total bookings?
It was 45% of total bookings in Q2 from the federal business alone.
That's a huge concentration. So what's driving this sudden surge? The source material mentioned they did this while navigating some serious headwinds.
That's the most fascinating part.
Yeah.
This happened despite things like the government shutdown. So this isn't just about winning contracts. It's about a fundamental shift in the market.
The move away from custom government solutions, right?
Yeah.
Towards off-the-shelf tech.
Exactly. The government is mandating a push towards CO-test commercial off-the-shelves. They want to stop building expensive, slow, bespoke systems and buy platforms that are ready to go. C3.AI is perfectly positioned for that.
So they're riding a massive federally mandated wave. That explains the deal volume.
It does. They closed 46 total agreements in Q2. And these are with huge names, too. Expansions with GSK, US Steel, Duke Energy, even AMD. These aren't just small pilots. These are deep commitments from major players.
And the value of those deals was significant.
Very. Total bookings jumped 49% just from the prior quarter. And within those 46 deals, 17 were for over $1 million, and 6 were major contracts over $5 million.
One of the biggest federal wins mentioned was with the Department of Health and Human Services. That includes the NIH, CMS. These are huge entities.
It's a foundational commitment. And look at the use case. They're deploying C3 Generative AI to automate complex, labor-intensive administrative workflows.
So we're moving beyond simple analytics to autonomous execution.
Precisely.
Wow.
Which brings us to their partner ecosystem. That has to be critical for scaling these complex deals. How reliant are they?
Extremely. In Q2, the partner network drove a full 89% of total bookings. This isn't just a sales channel.
It is their sales engine. And that pipeline is growing. Their joint qualified opportunity pipeline with all partners grew 108% year over year.
Let's break that down. The Microsoft alliance really stands out.
It's been incredibly productive. In just 1 year, it's generated over $130 million in bookings for C3.AI.
And in Q2 alone.
They closed 24 joint agreements in the quarter, and their joint pipeline with Microsoft is up 146% year over year.
That is a massive partnership. But is there a risk of relying too much on Microsoft, even with another giant like AWS in the mix?
Well, that's the strategic hedge. AWS is showing aggressive growth, too. They closed 9 joint deals in Q2, and their joint pipeline is up an incredible 172% year over year.
So they have two hyperscalers feeding them opportunities at triple-digit growth rates.
Exactly. It diversifies the risk and expands their market reach globally.
And beyond all the financial validation, they got a pretty big industry nod, right?
A crucial one. Verdantix named C3.AI a leader in industrial AI in their 2025 Green Quadrant report.
A leader or the leader?
The #1 vendor out of 19, ranks first on both technical capabilities and market momentum.
Wow. And the report highlighted their excellence in predictive maintenance, which blends time series ML with physics and LLM-assisted triage. That sounds complex. Can you break that down?
Sure, it's about being smarter than just pattern matching. Time series ML looks at historical data, like vibrations, to predict a failure. The physics-based modeling adds engineering principles to that.
So it knows why a part will fail, not just that it looks like it's going to.
Exactly. And the final piece, the LLM-assisted triage, is the bridge to the human user. The large language model can summarize the complex finding in plain English, suggest a repair, and maybe even open the work order.
It turns data science into an actionable instruction. That makes sense.
And that leads us straight to their newest products, generative and agentic AI.
Right. The generative AI product closed 8 new deals in Q2. We saw names like Cargill, Bristol-Myers Squibb, and the U.S. intelligence community.
And look where those first deployments are concentrated. A full 50%. Half of them were in the federal defense and aerospace sector.
That 50% figure really stands out. It shows the federal government isn't just a source of revenue, it's also the proving ground for their most advanced tech.
It's a symbiotic relationship. They get mission-critical, data-rich environments to refine the product. And that success led to their next big announcement.
C3.AI agentic process automation. This is their move into autonomous operations, isn't it?
The key word is autonomous. Instead of complex coding, a manager can just describe a workflow in natural language.
Can you give me an example?
Sure. Something like monitor our key component inventory, check geopolitical risk scores for those suppliers weekly, and automatically reorder from a backup if the risk score gets too high.
And the system just does that.
It automatically builds and deploys autonomous AI agents to execute that entire process in minutes. It's about encapsulating a whole business process, not just answering one question.
That is a massive leap. Okay, let's pivot to the future, the guidance. This is where we see that tension between massive bookings and near-term revenue.
Right. For Q3, they're guiding to revenue between $72 and $80 million. That range includes the analyst consensus of $75.6 million.
Okay, and for the full year?
The full year guidance is $289.5 million to $309.5 million, which also brackets the consensus.
After just reporting 89% bookings growth in your main sector, you'd almost expect them to raise guidance significantly. Is this just them being conservative?
I think it's a strong signal of caution and just the reality of enterprise, especially federal revenue cycles. The guidance implies that year-over-year revenue growth is slowing.
How much?
Well, the Q3 guidance actually reflects a potential year-over-year decline of somewhere between 19% and 27%.
Wow. Okay, so there's the divergence. A potential 27% revenue decline in Q3 right after an 89% bookings growth quarter. So why the lag? Why doesn't that booking number hit the top line immediately?
It's the classic challenge with large federal contracts. Bookings are signed deals, future potential. But you can't recognize the revenue until the software is deployed, integrated, and officially accepted by the client. That can take quarters. Management is signaling that deployment pipeline is the current bottleneck.
So what's their plan to accelerate that?
The CEO laid out a plan to focus ruthlessly on areas where they have a demonstrable leadership and a right to win. The goal is clear: get back to growth, generate cash, and reach non-GAAP profitability.
And we can see that in their expense guidance. They're managing the burn rate.
Correct. The Q3 non-GAAP loss from operations is guided to be between $44 and $52 million. It's still a significant loss, but it gives investors a clear roadmap to watch.
And just for context for you, the stock closed at $15.01, which is down significantly over the last year. So hitting these numbers and managing expectations is absolutely critical for them right now.
So what it all boils down to is a high-stakes bet on execution. They beat on the Q2 numbers, sure, but the forward guidance shows that the timing of revenue is a massive challenge.
So the story really hinges on two things.
It does. One, can they keep up the incredible momentum in the federal sector? And two, how quickly can their partners sell and deploy these new generative and agentic AI products into the commercial world?
So what does this all mean for you? Well, this analysis really illustrates that in enterprise AI, huge strategic wins, like an 89% surge in bookings, can be separated from immediate financial results by the massive, slow work of deployment. And that leaves us with a really compelling question to watch.
The new C3 agentic process automation is clearly revolutionary tech, and half its early traction is in the federal space. How quickly can that product, designed to automate entire industrial processes, pivot and become a foundational, revenue-driving application across major commercial companies? That commercial transition for their most powerful product, that's the next big challenge to watch.